everyone. Welcome to our discussion having to do with trusting financial statements. We're going to look at why it is that what we've set up to help us be able to trust them. We talked earlier about just how important the information is and being able to use it to make decisions. And so there's some things we need to look at from chapter 4, help us understand what it is that is set up so that we can trust those financial statements. So let's dive in here. First of all, let's talk about the Securities and Exchange Commission. Back in 1934, the SEC, as it's known, was formed in order to protect investors from those that might be unscrupulous, those that might try to cheat them by providing bad information about their finances. So the idea is that if you can trust it, it makes it easier. The SEC is supposed to help us be able to trust that information. So it's easier for the good companies, those that are doing well, that are efficient, who are making good business choices, to raise the needed money by making investors such that they know that what they see is what they can believe, and they can make judgment calls as to which companies are doing well and allocate their capital to that. They don't have to spend a bunch of time trying to decide whether the information is reliable or not. So they're protecting investors from bad information, but not bad investments. They are not saying, the SEC is not saying that if you see a company trading on the stock exchange, that they are necessarily a good investment. They could be a lousy investment. They could be headed the wrong direction. But if that's the case, that's what their financial statements will reflect that. So you're not protected from loss. You're protected from getting bad information and therefore making the wrong decision. So they have some rules about that financial information, especially that they have to be reported to the SEC and to the public on a regular basis, at least every 3 months, and again at the end of the year. So that is one of the rules that the SEC has set, and they review those filings on an occasional basis. They are a governmental entity, meaning they operate underneath the Treasury Department. They have the power of the U.S. government by law, the authority to go to protect investors, to establish the rules, and to enforce them. So they can go after, they have lawyers, they'll take people to court, and go after individuals and companies who do not follow the rules. They are usually will go after them in a civil court case, but occasionally, if it's really serious, they'll get the FBI involved and there may be criminal charges filed. This really only applies, the SEC really only applies to publicly traded companies, the ones that you most of the time hear about on the news, the ones that you can buy stock in on the stock exchange. If anyone can buy stock, that means that the financials need to be shared with all those people or potential investors. It's not really small companies. It's not those that are owned by only 2 or 3 shareholders, that sort of thing. They don't get the same attention from the SEC and may not have to follow the rules. They may have to be able to choose to do otherwise and not be illegal, because those things are only required of the companies that are traded on a stock exchange that are public companies. So in reality, the SEC has in turn delegated most of the responsibility for setting accounting rules to the Financial Accounting Standards Board. We talked about them a little earlier. They have their website we looked at. That is where the rulemaking has been in the United States. We refer to that as U.S. GAAP, or Generally Accepted Accounting Principles. They, however, continue to be supervised by the SEC, meaning that they can't really change the rules or set rules without at least reasonable approval by the SEC. So they're independent, but not, you might say, fully. They are not supported by governmental funds, the tax dollars, like the SEC is. They are supported by fees levied on companies that trade on the stock exchange. Just along with that, there's a International Accounting Standards Board, which sets rules as they see it for the whole world. However, what happens is each country then adopts its own version of those rules because they have no power. The International Accounting Standards Board, just like the FASB, has no power to enforce their rules. They can make them, they can write them, they can publish them, and the same with the IASB, that they have even less ability to do that because they're talking about over 100 sovereign nations where there's actually no authority at all to enforce the rules. So there is no such thing as an international SEC. There is no organization that can go to a country and say, your folks are violating the rules. So FASB has 7 people plus research staff, has no power. There's another organization, the EITF, Emerging Issues Task Force. When something comes up, which is either something that needs to be moved quickly on, but is not important to bother the FASB with, then they can step in and make what is usually looked at as a temporary rule until it gets around to being important enough for the FASB to look at. The difference is FASB has to solicit public comment. The FASB has to go out to the whole world and say, this is what we've decided, this is what we think should be decided, what do you think, and get feedback. And so it takes months and sometimes years to get the rules changed under the FASB because they have to keep doing this until they get people kind of on board with their rules. The EITF does not have to do that. They simply get together in a majority rules and they can change the rules in narrow areas and those areas that aren't that important by just having a vote. They don't have to go out to the public. So what does that mean for a company? So the SEC, in order to protect investors, they require that each publicly traded company be audited. They actually require now, under the rules since basically 2002, that they be audited twice. There is an audit of the financial statements that we've learned about. We learned about in Chapter 3 what they put on those financial statements, and an audit of internal controls. We'll talk a little bit more about what internal controls are. But it really is 2 audits. Some of the work is done simultaneously, but it is 2 audits and therefore 2 reports, if you will, on their audits. So these companies hire certified public accountant firms to do these audits. Other companies can hire and pay auditors if they want to, but they are not required by law, like those that are on the stock exchange. They could do that, and then they would be able to say to their investors, hey, look, we have provided this assurance, this audit that shows that our financial information can be trusted. So just a little bit about who provides these audits. In the world, there are the certified public accountants, and most of them work for what we call firms, which is basically just groups of CPAs. There are in the world 4 which are referred to as the Big Four. That means that they have international operations. They have accountants or CPAs all around the world. They have thousands and thousands of employees. They make billions and billions of dollars in fees because they are everywhere and they can handle an audit of a very large company. Then there is what's referred to as kind of a second tier, which are still big company, big CPA firms, but not the Big Four. and then it goes all the way down to one or two CPA firms that operate down the street from you, or for instance, okay. Small firms typically do not do audits, because audits are usually for big companies, and so they need significant personnel to be able to handle that. So to do an audit, you have to, if you're going to audit a publicly traded company, you must follow the rules set by the PCAOB. That's the Public Company Accounting Oversight Board. Public Company Accounting Oversight Board. They set the rules for how to do an audit. They don't set the rules for how to do accounting. That's the FASB, remember? But how to do an audit. They also are supervised by the SEC. So they can't do too much without, they're actually supervised a little bit more closely than the FASB, because the SEC actually approves people that sit on this board and make those rules. If it is an audit of a company that's not publicly traded, there is a separate group called the Auditing Standards Board, which is part of the American Institute of Certified Public Accountants, getting all of our acronyms in. They set audit rules for all the rest, for anybody that is not publicly traded. If you do, so if you're a CPA, you have to, and you do audits for public companies, you got to know the rules from the PCAOB. And if you do audits for non-public companies, you need to know the rules for the ASB. Now, it's not as bad as you think. It's not a whole set of rules. The PCAOB rules are more exact, but they're very similar to the ones by the ASB. Okay, it's not like there's a whole separate set of rules. It's just kind of the level to which you have to, the rules and the detail on which the rules are set. So the idea here is that this audit, this checking of the financial statements to make sure that they are fairly stated, requires what we refer to as independence. That means that the auditor, certified public accountant, okay, it needs to be independent. They cannot be an employee, they cannot be an investor, they cannot be a stockholder in the company that they are auditing. Otherwise, they would have a conflict of interest. They would look as if they were not independent. So we put a lot of importance on this concept of independence. And there's a bunch of rules about, can your brother own stock in that company? Can your kids own stock in that company? Can your dad work for that company? All of those things are looked at as saying, okay, could that make us look like we're not independent? Meaning, would I, if I were auditing a company where my dad worked, would I be able to be unbiased when I looked at their financial information and I saw something that made them look bad, or they were trying to hide? Would I use my best judgment and still be honest about those financial statements, despite the fact that it might hurt where my dad works? So that's the kind of thought process and thinking that goes into making rules about independence. So what is an audit? What is it that we're doing? Okay? So some things you should understand about an audit. First of all, checking the information is about getting a reasonable assurance, not absolute assurance. Just like we know that financial statements are not perfect. They are not completely correct because there are estimates, because there's rounding, because there are possible mistakes. But we are going to do enough work and gather enough evidence to decide that there is a reasonable person can feel good about that the numbers reflect what's really happening at the company. There is no way we can get to the point where we can say, absolutely, I know that this information is correct. That would take years of work. It would literally take you doing everything that the accounting people did a second time. Okay? And that is not possible or reasonable. So we're looking for reasonable assurance. remember that the company itself is responsible for preparing the financial statements. The income statement, balance sheet, statement of equity, cash flow statement is all the responsibility of management, the people who run the company, not the auditor, not the CPA. So what we do when we come to be an auditor is we gather evidence to support what's on the financial statements. So if you think about it, think about all the numbers, the items and the amounts on a balance sheet, for instance. So the first thing you come to is cash, and it would say how much cash they present that they own. What is that asset? So you're going to, as an auditor, your task is, what evidence would I need to look at to make sure that number is close enough to what really happened to not be misleading, that there is not a material misstatement in that number of cash. So you're asking yourself, what would make good evidence? And the point is, and most of us have watched enough lawyer shows and stuff to kind of know the difference between good evidence, like hearsay, or someone just saying, you can't just go to the company and say, how much cash do you have? And they say, oh, we have that much. Yeah, sure. And say, oh, that's good evidence. That's them reassuring you of something they already told you. What you're looking for is some kind of corroboration, someone else outside the company who can corroborate their story. So you might contact the bank and see what they say about how much cash they have, and whether if there's any restrictions on that cash that they might have forgotten to tell you about. So that's the start of good evidence, getting it from someone that would have no reason to lie. So we cannot get evidence on everything. We cannot check every transaction. So we take samples as an auditor. We might say, okay, we know these various transactions happen. We know there's 100 of them. And so we take a random sample and check them with the idea that if there were mistakes in those, there's probably mistakes in the rest. If those that we sample look good, then it probably indicates that the rest of them are done well as well and done correctly. However, there is some new technology that's starting to lead us to ability to actually do continuous auditing, which may mean that at some point, because we use software instead of people to check transactions, we may be able to check every transaction, what we call continuous auditing. And then your issue is your software looking for the right things, and is the software reliable, that sort of thing that you're using. And of course, it would be software that the auditor uses, not the company, because obviously the company we can't just say, well, company creates software that checks itself, because then we wouldn't know for sure it was working. We would have to redo estimates or consider what they put into their estimates, whether that was correct and whether it was appropriate, and if they applied that information correctly. So we would recalculate their estimates. We would look at their underlying calculations to see what they did and how they came up with them. And ultimately, this audit is leading to our opinion. And that's all it is. It is an opinion that we're going to provide reasonable assurance that it is fairly stated according to the rules. Not that the company is going to go and do well, not that the company is going to do poorly or anything like that, just that the information provided in the financial statements reflects what really happened, in our opinion, with a level of reasonable assurance that it does that according to U.S. GAAP. So that's what our opinion ends up being.